Warm welcome to all. Good evening to all the participants. And first of all, thanks for giving your time after markets, especially when there's a long weekend ahead. Well, just to start off my presentation, this month, the month which has gone by, the April series, was one of the most volatile months known in the markets. Actually, if you look at the last 3 months, it's been a roller coaster ride for the market. But the positive takeaway was that we closed almost around 650 points up over the prior series in the April month. So this comes in a set of straight back-to-back positive trading sessions, which we have seen starting right from the levels of 22,000 to around 24,300 odd levels where we currently trade. So this recovery of 2,000 points from the swing lows of 21,800 has come one way in just a matter of 10 straight trading sessions. So that's the kind of volatility we are in, and we have been a part of this game in the last 3 months. So really, you can blame this on the domestic or the international factors, but that's the nature of the market we are trading in. Now, here when we talk about volatility, we cannot speak on talking about India VIX, which is the volatility indicator. Now, before we spoke about what US markets are doing, how the global events are playing out, what is the next move of Trump. And in all those events, VIX did manage once to get about 20, but eventually we had a time where VIX actually cooled down all the way to 15. But recently, since last 3-4 trading sessions, again, there has been an escalating Indo-Pak tensions over the border. And that is the reason why, again, there is a new event or a new kind of uncertainty which stares our face. And that is the reason why in the last 4 trading sessions, VIX is back above 18%. So that means, yes, we are again in a phase where we will be tiding over volatility. And in this session of mine, which is a short session, I will take you through how do we look at the Nifty for the month of May, which sectors do we look forward to, and how do we strategize ourselves to safely tide over for the month of May. In our prior webinar, we clearly said that despite volatility, we are looking at the seasonal factor of April to play out, where we believe April month should be positive. And luckily, the markets have respected our view. So if you look at the rollovers for the month of the May series, the rollovers suggest that positive long positions have been rolled over in the May month. Now the rollovers were 79% over the last 3-month average readings of around 80 odd percent. The options data which we tracked very closely, the FII action which we track very closely, all are suggestive that broadly the markets are still have some more room left on the upside, as right now last 4-5 sessions it's been a kind of a bit choppy for comfort around the levels of 24,350. Now if you look at the graph which is below in my presentation, I have drawn a blue line which is the support zone. Clearly this support was a breakout. This is a possible breakout. You may call this a range breakout, or you may label this as a double bottom breakout. Some may say this is more of an inverse head and shoulder. Whatever name or form it comes in, the key takeaway is the level of 23,800 to 850 zone. This is the Lakshman Rekha which you need to consider if you are a trader and an active trader for the month of May. So till this level of 23,800 holds on a closing basis, we will continue to maintain a positive stance on the market with a possible upside target which we look forward to is 24,800. That's a minor swing high, and 25,200, which is the second broader targets we look forward to. Overall, we continue to maintain a positive stance on the market considering the conditions we are in right now. Choppiness will be there. The only reason to worry is VIX, because that is more sentimental. There is a long weekend ahead. There is a fresh tension play which is on, the Indo-Pak tensions which I just spoke about, and that is keeping the markets on the edge as of now. But really, till there is some action taken, all we have to do is wait and watch. But irrespective of that, we feel that as the data placement goes, the markets are still positive. Now, Bank Nifty in this entire scheme of things has been the stronger of the two indices if you look at, and this was the leader in the last couple of months. But now we believe leadership shifts in the month of May, and Bank Nifty might take a back seat, and it's going to be Nifty which is going to dominate the proceedings from here on. So Nifty has to be the leader, and especially from the leadership front, if you were to look at Reliance Industries, this stock has come out of an hibernation of 5 odd months, and the breakout which we recently noted a couple of days back at the levels of around 1360, 70 odd levels, I believe, post results, was one of the 5-month breakout on the technical parameters, which just puts the stock on a very firm footing, possibly setting this up for targets of 1450 to 1500 in the month of May. So Reliance takes the leadership. Second, banks now possibly, which were the savior for the indices in the month of April, will take a back seat. Now what will play here is the possible IT names, Infosys, TCS. These were the beaten down names. These were names which were in the pain zone in the last 3 months, and somewhere I believe the way the short positions were set, the short covering which we noted, a positive reaction despite muted results in the IT names, all are suggestive that IT is the second sector which might support the indices, or the Nifty rather, as I may put it, in the month of May. Bank Nifty, to the contrary, has been the leader. It will take a back seat, but that doesn't mean that there is going to be a correction in Bank Nifty. It gets into a sideways consolidation, as a time correction as we call it, where possibly Bank Nifty trades in a range. The possible range will be 5400, 54,000 on the lower end, and 57,000 on the upper end. This is the broader range where Bank Nifty is expected to be, and with the rollovers of 75 odd percent over the past 3-month average rollovers of 79%, clearly the long bets are going a bit slow in Bank Nifty at the all-time high levels, which just indicates that it is more of a pause which Bank Nifty may take in the coming month, that is the May series. So we have to talk about the FI numbers here whenever we talk about the view on the market. If you were to look at the FII in the prior months, when there was a sell-off, continuous sell-off, 5 महीने से बाजार continuously गिर रहा था, और FIIs were the one segment where the entire market was looking. क्यों FIIs पैसा अपना निकाल रहे market में? What has been the lowest point of that? Every data was sliced in before the Trump factor came into picture, and now really FIIs, how their position takes a backseat. And I believe if you just look at the numbers for the month of April, it gives a more clear picture. So on the left of my screen here is the FI numbers from 21st of April to 29th of April in the cash segment. Really all day-to-day numbers in green. On an average, you can say 2 to 3,000 crores is the daily buying in cash, which is a very healthy positive set of numbers coming in from the FIIs in the cash market. So that's a good signal as I see right now. And even if you were to compare it with how the FIIs are positioned in the leverage market, which is when we talk about the index future segment, again you have more of a sea of green, leaving us out the 25th of April, which is more of an expiry related game. All the numbers here are positive. The long short ratio, which was subdued to 20% in the last 3 months, has picked up all the way to 45% as it currently reads, and that's a very healthy picture which paints the overall structure we are in, the setup we are in the current market. So tick off, FIIs are there, their numbers are there to see. Yes, you're talking about war. If FIIs have tension, they will pull out their money. The numbers will be apparent here. So watch this section very closely. We update you on in this section on our daily reports, in our daily con calls, on our daily media appearances. And I think FII numbers are the numbers to be looking forward, because if we talk about war, FIIs will be the first one who will be reacting in terms of the way they position themselves in the Indian market. Still now, there is no concern as I see. There is a renewed interest which is garnering in terms of fresh inflows, which we have been noting since the last 10 to 15 trading sessions. Now, the next slide talks about which sectors we should be watching for. Now, clearly, this is more of a short to medium term analytics. It is purely based on how the rollover numbers came in for the market, and based on the technical setup and the derivatives data, we would closely watch at sectors like cement, where there is a positive price traction. We believe many sectors, many stocks like an Ultrasemco and Ambuja Cement, Grasim, these are the top three bets in the cement space, which will probably take the lead going ahead. Reality space, DLF, has been one beaten down name. Lodha or Macrotech Developers is the second name, which has an excellent technical price setup combined with long additions. Power sector, Tata Power, Power Grid, NTPC. These are three names which have been more of a safer bet considering the kind of price moves they display. But clearly long additions are apparent in derivatives. Technical setups, although they are more range bound, they are suggestive of a possible breakout in the making. So watch for these three names. Banks, they have been the darling of the markets in the last 2 months, and from here on you have to be very choosy when you select banks, because banks have had their fair share of run up. So if you were to choose banks, the stronger names in private banking would be an HDFC Bank, an ICICI Bank, an Axis Bank. Despite its numbers reaction being a slightly negative, it will be fast in recovering back. So Axis Bank is one good name you can look forward to. Bandhan Bank and RBL Bank are the other two names which are from the mid-cap banking names which have strong technical setups. Lastly, not to mention oil and gas with Reliance getting back in the game. अभी Reliance का आप देखिए, जो मैंने कुछ देर पहले बात करा था, it has staged a 5-month technical breakout, and that's a major development as far as price action goes. Clearly 1500 targets are in the making in the medium term version of the market. Strong supports at 1350. BPCL, HPCL, other oil and gas names, ONGC, they are also slowly picking up the price traction on the buy side. Long additions are apparent, and these will be the names you should look forward to. Now below there is a graph which I present you, which is more of an open interest graph. The skyscrapers which you look at, the red one is the put writing open interest, and the blue skyscraper is the call ratings open interest, and this defines the boundaries of the Nifty for the monthly 29th May expiry. Now if you look at 24,000, this has the highest open interest in puts across all strikes. So right now we are about 24,000, but 24,000 put writers are so adamant that even for the monthly strikes they are writing it big. And if you look at the broader premiums which this strike commands, I think it coincides with the levels of 23,800. That's the technical support which I discussed a few minutes back. So 23,800 is the level. 24,000 in derivatives put writing, you have a confluence of 23,800 to 24 zone. So till 23,800 holds, do maintain your long stance on the market. There might be some choppy moments in between on wars or some global concerns, but take this as an opportunity if you get markets on dips near the 24,000 marks. Strict stop losses below 23,800 on a closing basis on all your long positions. Things may reverse if 23,800 breaks, but still it is holding on. Data points are not changing, so sentiment will be a fear factor, but leave it aside. When it happens, we will consider it. Right now all the things still stand in favor of a bullish setup for the markets. On the upside, 24,500 is where we are heading for. That's what the upside call writing action suggests. Now FIIs 45% plus. On an average, if you look at this data points, they were around you can say on an average 20% in the last 3 months in terms of long positions compared to the short bets. So this has improved significantly. Key levels we discussed. What events you need to watch to for the month of May. One will be the quarterly results. Big boys of the markets have already declared their results. Majority of them still to go, but it will be a more of a stock specific game. In such situations, we do come out with a result play. In fundamentals, you have the expectation notes which come out from our derivatives desk. We come out with strategies how to play before the results come. So do keep track on and trade actively. We have been doing very well on these result plays using options to strategize the results. domestic developments on Indo-Pakistan tensions, that's what holds the highest weightage in the current market scenario. You have to be posted on the news factor. If the reaction does, if there is some escalation, you can expect a temporary pain or a reaction. But on the positive side, if you were to look at historical data, whenever there have been wars, whenever there have been surgical strikes, whenever there has been such kind of tensions around the border, the reactions have been short-lived. What comes after that is important. That is where the returns have been 2x of what the short-term pain was. So consider the broader picture and don't get carried away by the short-term pain factor in the market. That is what I would like to talk about. Global news, yes, right now they are taking a backseat, but you never know when the sleeping devil can get back again in the game. But right now, global news, the tariff thing which was holding high weightage last month has taken a pause right now. So I believe at least in May, this will be the news factor, which will be more of a cool-off factor and will not disturb much of the market proceedings, at least for the month of May. But these are the three important news factors which you should look forward to. Now, how do you strategize yourselves? Now, that's a very important thing in such volatile situations, because one is you have a rising VIX. Now, when we talk about strategies, we talk about how the investor fraternity plays out and how the traders play out. So for investors, it is clearly wait and watch. The markets are still good. Pain points, take it as an opportunity, take it to go long on stocks which you shortlist and be present in the market. For traders, it is one of the most excellent setups, because buy on support, sell on resistance is what the technical setup is. Levels we discussed, if you are a directional trader, 23,800 is the level. That's the firm support you look forward to. Till it holds, it's a positive market. 24,800, 25,200, these are the two targets you work with. How do you strategize via options? Well, to play out such volatile moves, the best way I would suggest is build an iron condor strategy. Now, what an iron condor is, you build a strategy where you sell calls and puts at the extreme end of the range, and you just back it up by buying deep OTM calls and puts, so that worst case scenarios are protected. So here, when we talk about 23,800, we are selling 23,800 put. When we are talking about 24,800 to be resistance, there is where we sell calls. So you define the price band: 23,800 put sell, 24,800 call sell. Now you have a 1,000-point packed range where you have sold options. To protect this range, what you do is 500 points away from the puts and away from the calls, you are going to buy options. So just in case, the initial volatility which you have, some directional move, if it kicks out, you are protected. You know what max you can lose in the game, and you will not have sleepless nights. You wouldn't be tracking global events as when you have a naked option positions open. So covering up, having hedges is the key in this game as we head into the month of May. My belief is that May month will be a more tamed month than what the prior 3 months have been. Despite the news flow currently is a bit out of comfort, but overall the expectation is we will be sailing smooth. It will be a positive month, initially a bit choppy, but finally things should settle down. That is what the call on the market is for the month of May. Do follow our recommendations and follow us on all our WhatsApp channels and social media. That's the short presentation I have for you. Thanks all for your time, and we will take it ahead from here for the question and answer session.
Please explain some adjustment of iron condor strategy.
Yeah, so it's a very good question, because iron condor strategy is a strategy where when you set it, your payoffs in advance. Now really we can actually have a detailed webinar on this at some point of time about how the strategy works, but the whole point of the strategy is you have a neutral view on the market. You build a range for the market. When I just spoke a couple of minutes back, 23,800 put sell, 24,800 call sell. By selling calls and puts, you are building a short strangle. You are defining a range where you expect the markets to be in. Now the problem is, what if there is a directional move like it happened in the past 2 months? If it moves out of the range, what will happen? Now really, if you have no hedge positions to cover this up, what? So just to tackle with this uncertainty, you buy out of the money calls and puts to tackle such situations, so that the worst case scenario is under your control. Now strategy is set and done. Now there are times, like suppose you would have set the strategy last month and really you have a directional move which moves out of your range. Now what? Now the whole point is moving or changing the range of this iron condor with the market. Now, you don't go too close where the ATM is. So, for example, when you set the strategy, ideally the strategy is set at the beginning of the expiry. You need not touch this, whatever happens in the prices till the first 10 days. After 10 days, the time value kicks in for the option premiums, and that's where strategy repair or adjustments is the next key point, because the middle part of the month from 10th to the 20th is a very sweet spot for the market. That is where your time value, intrinsic value all come into play, and here is where, suppose that directional move is already played against you, that is the time where a shift or an adjustment or a repair needs. So, for example, suppose we set this strategy today of iron condor, and let's say by 10th of May you are in a situation where Nifty crosses 25,300. Now 25,300, let's say, is the extreme end of the plan where you bought calls. Now really you are in losing point in the strategy, but your losses are in control. Now what we do here is we book out the profits in the lower band leg, like the put which you sold and the put which you bought, and you gradually shift this up to higher strikes. Higher strikes where you shift will depend on the new technical setup and where the open interest developing for the next 10 days. For example, let's say market's open interest now shift to 24,500. So what you do is now you sell that put from 23,800, you shift it to 24,500 now, and the puts which you have to buy now, the initial one which you bought 500 points away, you will buy 500 points away from the 24,500 put which you sell right now. So it's a shifting, but generally with such shifting, it all depends how aggressive you are, what is your take on the market. But shifting conservatively will help you save your loss or control your loss or bring down the losses to zero. Aggressive shifting will help you take out some profits from a losing situation. So really that needs some expert advice, which we are always there for you. But this is generally how the shifting is done. Do not follow the markets blindly. Give it some time. But if personally I were to do the shifting, 10 to 20th, that's the mid-month, is the only time where I will consider this shift. I would not touch or shift or repair the positions in the last week of expiry or in the first week of the beginning of the new series.
Explain and elaborate on put-call ratio.
Look, PCR or put-call ratio is a parameter for analytics in the derivative space. Now what you do is you have to look at the option chain. In the option chain you have calls, all the strikes, and puts where it defines all the different strikes for puts. Now PCR is all about, there is a PCR based on volumes and PCR based on open interest. Normally we track PCR based on the open interest. Open interest means positions which stand open at a given point of time. These positions can be shorts or these positions can be longs. Now what is PCR? PCR is put call ratio. So you have puts in the numerator, calls in the denominator. It is a ratio which you derive by adding up all the open interest, all the open positions in puts divided by all the open positions in calls. So main thing to understand is you get a ratio which is at or below, above or below 1. If it is above 1, it means there are more puts in the system. That is why you have the ratio above 1. And when it is below 1, it means you have more calls in the system. Normally, what we do in derivatives is that when we analyze, we believe that the writers have an upper hand. They are the smart money. They are the leaders or the people who command a chance of higher probability of success in the market. So that's why you see HNIs, institutions, they are all into the option writing business. So although expensive, it gives you high probability of success. Fixed money management, money return kind of concept which works here. So when you talk about put call ratio, if put call ratio is going above 1, it means a positive view. If it goes below 1, it means the call writers are more active. It means a negative view. And there are extreme points, like let's say put call ratio goes to 1.5. It is a point where the puts are so high in the system that there is a good chance that now the put writers can be caught in the game. It might surprise them. So extreme points, at least for Nifty, if PCR goes above 1.5 or PCR falls below 0.7, these are the points which you need to consider as a contrarian. Above 1.5, consider the market to be overbought. Below 0.5, below 0.7, consider the market to be oversold. You can go for a contrarian bet based on some other technical indicators which you have to use in conjunction with the PCR. But as a thumb rule, consider PCR going above 1 is positive for the market, going below 1 is negative for the market. So just don't zero down at 1, leave some buffer. So I personally track it that if it goes below 0.1, it means the market has selling pressure. If it goes above 1.10, it means the market has buying pressure. So that 0.10 plus minus from 1 is the buffer I give, and that's how I look at the PCR ratio.
What are the margin requirements for option shorting?
Option shorting is always equivalent to taking a similar trade in the futures. So consider whatever margin your futures market demand for one lot of that the product which you trade. The similar margin would be needed for trading in the options if you are a writer or you are shorting that stock or the index. For example, let's say you are shorting Nifty, which today has a contract size, I think, of 17 or 18 odd lakhs. I think 3.5 odd lakhs is the margin which you need if you were to take a trade in futures. So let's say you have a buying view, you buy futures in Nifty with a positive view, you pay 3.5-4 lakh as a margin for trading Nifty. If you were to short 24,000 puts, when you short puts, it means you have a positive view in the market, but you are using options as an instrument to take a positive view in the market. Here, the margin requirement too will be around 3.5 to 4 lakhs, similar to that in futures. So that's how option writing, you have to pay more money equivalent to this how you would trade in futures.
How do you hedge a portfolio?
Portfolio hedging is again a complicated topic. We'll need an entire 1 hour webinar for it. But just to keep it simple, when you use options to hedge portfolio, one is you buy puts. That is, if you have a portfolio, first of all, you need to understand what is the beta of the portfolio or what is the exposure of your portfolio stocks to the Nifty index, because you are using Nifty index to hedge your portfolio. So here it's very important that majority of the stocks which you own should have or should correlate with the Nifty or have a high beta to it. So if Nifty were to move by 100 odd points, then your portfolio should also more or less move in tandem. That's the whole idea. So if you have a negative view or you are not concerned about the market, like in the current situation, you want to hedge, then buying puts in Nifty, since you're trading on the Nifty, is the best way out. If your portfolio has a larger section of banking components in it, use Bank Nifty as a hedge instrument. If your portfolio has more mid-cap constituents in it, use mid-cap Nifty as a hedge tool. So how do you exactly hedge is you buy puts. Now which strike to buy, where to buy is all a very complicated thing, but the whole idea is that you should first predict how deep you feel the markets will fall. First understand that if you are expecting a 500 point fall in Nifty, then which strike of put will you buy is the next thing you zero down into. So maybe you zero down into a strike which is 500 point below from the current market price, or you can use the ATM also or deep OTM also. But the whole, I personally feel that it should not be very deep OTM just for the sake of it. So if a 5% fall in the Nifty, if it is, let's say 500 points is what you're expecting a fall, your fall of 5% in your portfolio or the losses of 5%, at least 2.5% or a 50% hedge should be offered by buying puts, at least 25 to 50% depending on how you believe the fall will be. So it's a very complicated thing, but buying puts and is the way you hedge. For more detailed explanation in hedging, I think we can have a webinar, or you can contact me one-to-one, because how much quantity to buy, which strike to buy, these are all complicated things which is very in this short notice of time I cannot complete it. But buying puts is the way out for hedging, or shorting futures is the other way out, but again that's a more riskier instrument. So right now we limit ourselves to buying puts to hedge portfolios is what you need to understand to keep it simple for most of our retail investors.
When does the monthly open interest typically get built, and what is the best day to take positions in options?
The highest open interest ideally gets built during the expiry, monthly expiry day. 3 days before monthly expiry, 1 week after monthly expiry. This is the sweet spot of the market where majority of option trades get committed. Now, firstly, you have to decide how you trade options. Are you more of a momentum trader, where you are there for scalping or short-term momentum trading, chasing price breakouts? You are happy with the 10, 25, 40 odd percent returns in 3 or 4 days. Basically, if your idea is holding trades for 3 to 5 days, then really which time, when and all don't matter. Your technical reading comes into picture. If you are one of those who have a clear fixed target in mind, a 10% target, 8% target for the stock or the index you track, and you are very clear on the view, and you buy the option with the view that you are going for a 4x or a 5x kind of trade, then all these factors come into play. But the highest open interest, which is the question addressed here, typically builds in the plus minus 5 days from the monthly expiry date, and that's where the view sets in.
Which is the best option selling strategy?
The short strangle, where you only sell calls and puts, that is the most popular, most followed strategy by one and all. I can say almost 80% people in the market are selling options, building short strangles. But personally, I feel that is a good strategy, assuming your volatility index is below 14, below 1.4. If VIX is below 14, volatility is less, your premiums are less, but such strategies have a great success ratio. Normally, you end up success 7 out of 10 times, but here with a VIX below 14, the success ratio goes higher. Risk is comparatively lesser. But at a VIX of anything above 17 or 18 plus, it is very important that any short strangle strategies you build have to be covered with deep OTM calls and puts, by which we classically call as butterflies, or we call as iron condors, where any strategy you build in VIX above 18 is a strategy where you know your risk in advance in worst case scenarios, and an iron condor would do more justice in the current market scenarios.
Thank you, Akshay.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.